Welcome to the Long-Term Investor. With me today, I have two special guests from Vanguard, Liz Ann Muirhead and Natalie Marvi-Romeo. I am so excited because they are going to help us talk a little bit about choosing the right investment strategy for you. Natalie, Liz, thank you so much for joining us. I would love if each of you could start out by just giving a little background and let our listeners understand a little of what you specialize in and what you're bringing to the conversation today.
Okay, well, maybe I'll jump in and start. So I'm Liz Ann Muirhead. I have had 25 years in the investment industry, all of them at Vanguard. I am a CFA charter holder, and I have a decade of experience in manager research. My experience has ranged from a wide range of active equity as well as index. My index focus has been primarily on the fixed income side, and then I've also overseen active fixed income products. So today, I'm in a role where I provide Vanguard's insights and outlook to financial advisors and their clients.
Great. Thanks, Liz. I'm Natalie Marvi-Romeo, and I'm also a senior portfolio specialist here at Vanguard, and I'll stop at 25 years of experience in the industry, but I'm relatively new to Vanguard. I've only been here a year, and I've spent my career at both boutiques and global asset management firms in a variety of roles the last 12 years, client-facing both institutional and financial advisors. My most recent experience was on a U.S. small cap team as their client portfolio manager. And as we like to say in our role, we sit at the intersection of our client financial advisors and also our internal portfolio managers and our external sub-advisors, and we're here to answer questions.
Well, again, I'm so pleased to have both of your perspectives here, because when I think of choosing the right portfolio for an investor, I'm really a believer in the idea that there is not a single one-size-fits-all portfolio that's right for everyone, and that the perfect portfolio is really the one that you can stick with for as long as possible. And at PlanCorp, when we're bringing on new clients, we usually introduce them to three different strategies, one of which is indexing, the other of which is factor investing, and the third is ESG investing. And I wanted to be able to create a conversation around these things. And I thought, who better than Vanguard, who offers all these strategies and doesn't really have skin in the game as to which one you choose? Because I know I often tell our employees and our prospective clients and clients that if I had to pick one of our model portfolio strategies out of a hat blindfolded and live with it for the rest of my life, I'm going to be fine. Everyone thinks there is going to be a right answer and a wrong answer, only in hindsight as to which did the best. But I think what I would like to try to do today is walk through these three equity strategies at a really high level to give people a sense of what is out there and what might resonate with them as a strategy that they could stick with as long as possible. And Liz, I'd like to start with the factor portfolio, which I'll quickly define as just a systematic way where people are overweighting certain characteristics in the market that have historically earned higher returns. I'm curious if you could kind of supplement my definition and maybe start by explaining what the case for factor investing for a portfolio might be.
Well, I think I'm going to draw on my experience in manager research. And one of the things that was really important for me in that role was to understand the alpha that an active manager creates. And I think factor investing has been born out of an evolution in our understanding of that alpha. So attribution models used to assess manager skill have really come a long way. Back in the 1980s, we were comparing every single manager to the S&P 500. Then we got a little smarter and we recognized that value and size were significant influencers of long-term returns. Enter the equity 9 box and style-matched benchmarks, further isolating the true value added by investment managers. But then attribution models got even more sophisticated, and we started to recognize that most of the apparent value added by active managers was actually coming from strategic factor biases rather than true manager skill. So some investors started to question, hey, why am I paying an active manager for an exposure that I can replicate systematically at lower costs? Managers had to justify their value add above and beyond both beta and factor exposures. And as you said, empirically, there's well-proven support for factor risk premia in areas like value, momentum, quality, liquidity, and volatility. And the current environment, the technology and the data available has allowed managers and firms to offer systematic and index structured factor products with consistent exposures to their targeted factor, all at low costs. So the strategic exposures to these factors can enhance returns if investors are patient. 10 years ago, there was some argument that these factors get crowded out because everybody knows about them. Even if people know about them, it doesn't mean that they're patient enough to wait the entire decade that it took for value to start to come back against growth in our recent past.
Well, and maybe if I were to try to highlight some of the downsides of factor investing, is that while there's a lot of empirical evidence supporting it, it can be very difficult behaviorally to stick with. Because when you mentioned 10-year periods, and if you look at 20-year periods, the win rates are really great. But 20 years feels like an eternity, and people may not feel like they have 20 years. Now, I've done episodes on how I believe everybody has 20 years, whether you're 30 years old or 80 years old. But what other potential downsides to a strategy like this would you see, Liz?
Well, I think you hit the nail on the head with the most important one is that style factors can underperform for long periods of time. So patience to stick with your investment strategy is paramount. But there's a couple of other things that I would highlight. Second is that there's no one market clearing, well understood way to do factor investing or build factor portfolios. And so you really have to understand what your provider is doing, how they're building the portfolios, and whether there are any unintended exposures that you might have as a consequence of that particular approach. A third thing that I would highlight is that factor investing may not be tax efficient and often is not. So for a taxable investor or an investor where taxes are a really important component of their long-term return, you need to be very cognizant of the tax inefficiency of factor products. And then the final point that I'll make is really the accountability here is in the investor's hands, because they're putting the money to work in these different factors, and your success or failure in achieving the long-term empirically proven benefit of those factor biases is going to be related to whether you can stay the course, using our little Vanguard term, and really wait through some periods of underperformance and volatility to get to your long-term outcome.
I could not agree more. And I do feel like for factor investors of the past decade, anyone who is in a factor portfolio knows that it has been challenging to watch indexes outperform something that you might have signed up for with the expectation of index beating returns. And so I'm curious, one last question on this before pivoting a little bit is, Liz, do you feel like there is any characteristic of who would be a good fit for a factor portfolio in your opinion?
Yeah, so I think that an investor who is committed to using factors as a strategic tool and not a tactical one is going to be a really good candidate for factors. Factor rotation is really hard to get right. Most managers who've tried that strategy will underperform, and so somebody who can commit to using them as a long-term strategic tool, who can wait out periods of factor underperformance, are great candidates for it. And then somebody who also can either tolerate a tax inefficient portfolio or has adequate space in their tax sheltered accounts for their factor investments. Maybe another use case, just as an add-on, is sometimes there's an investor who's built a portfolio of high conviction active products. And in doing so, they may recognize that there is a factor tilt to their portfolio that is unintended and perhaps not empirically supported. A small allocation to a factor strategy can actually help neutralize that unintended exposure while still keeping them invested in their highest conviction products. So that's just one little potential use case where it's used as a satellite instead of a core investment.
That's great. And one thing that you had mentioned a moment ago was how there are so many different definitions of factor investing. And Natalie, when I think of ESG investing, there are a lot of different ways to be an ESG investor, and there's a lot of ways to measure those outcomes and create the scores that overweight those. But before we jump in there, what would you say is the case for ESG investing at a high level?
Yeah, you're absolutely right, Peter. There are so many different ways to approach ESG, and it's the hot trend that everyone's talking about, right? Is it a product? Is it stewardship? Is it risk? Is it opportunity? And I think a good place to start with a case for ESG investing is talking about the sentiment shift that we've seen from investors over the past few years. If we think about the investment rationale, people used to think, if I'm going to be an ESG investor, I'm going to have to give up some returns, right? And that wasn't really palatable to people. But now it's really shifting to a belief that integrating ESG risks can really potentially improve returns. And if we think about it, there's a lot of research out there analyzing ESG funds and their returns. We've done some here at Vanguard. We analyzed US equity, ESG mutual funds and ETFs over a 15-year period. And just very briefly, the conclusion is that ESG funds have neither systematically higher or lower raw returns or risks than the broader market, and that you really have to look at it fund by fund. So when I think about it from Vanguard's perspective in the broadest sense, we think about first, what's our mission? Our mission, of course, is, everybody hears it, it's giving our investors the best chance for investment success. And when we think about that from an ESG perspective, we have a belief that unchecked ESG risk can really negatively potentially impact companies' long-term value. And so, we're going to be thinking about that as we're engaging with companies, as we're voting proxies. And I think Liz will talk about that a little bit later, as we talk about indexing, but just wanted to give some examples to people just to kind of crystallize what these ESG risks could be that could impact value. And if you think about, for example, a mining company, right? And you're a shareholder of this mining company and the mine collapses. Of course, there's loss of human life, most likely, right? But there's also environmental risks, right? Maybe it's spewing chemicals onto the ground and it's getting into the water table. And then you think from a shareholder perspective, what is the impact of those fines, of the cleanup? Well, it's probably going to translate into value destruction. And then if you think of it maybe from a service company perspective, what could be a material ESG risk for them? It might be data, right? Data is pretty important to most service companies. Think of a bank. And if they have a data breach, what happens then? Fines, expenses, and importantly, loss of customers, both current and potential customers. So, just wrapping that all together, ultimately, we think that focusing on the company management and the board and making sure that they're aware of ESG risks for their company and making sure that they prevent those from becoming governance issues will help preserve the long-term value of the company.
And it's so interesting how wide-spanning the issues that go into these considerations in the first place are, especially when there are so many different ways to implement an ESG strategy or try to either make a difference or just highlight those doing well. And ultimately, it does seem like there is no right or wrong way per se. It's just really defining to you, the investor, what does it mean to be an ESG investor? And I guess,
Right.
Natalie, maybe you could walk through some of the high-level approaches that people can take to be an ESG investor, along with maybe some of the upsides and downsides of the various approaches.
Sure, I'd be happy to. Peter, you hit the nail on the head, right? It's so personal. It's personal to the person and their values. And there are many different ways, products that you can approach it. I'll try to encapsulate it into just a handful. And I'll go through those and then I'll talk about the upsides and downsides. But, first and foremost, the oldest method, socially responsible investing, probably people are most familiar with, is negative screening, exclusionary. I don't want to invest in these types of companies, either because they offer a product or service that doesn't fit with my values, or they violate principles like anti-corruption, the environment, labor practices, things of that nature. And then also under screening, there's positive screening. There's a lot of ESG rating agencies out there that fund managers can tap into and target those companies that have the best ratings vis-a-vis their peers or other investment opportunities. And then next would be active ESG. This is where your fundamental managers are going to be taking into consideration ESG risks and opportunities right alongside doing their fundamental analysis. And most likely too, they're going to be engaging with company management, with the board, trying to influence them to do the right thing over time. And then as we get deeper into this, there's impact investing, which probably people hear a lot about, right? Because it really plays to your personal values. I can have a positive impact on the environment or society. Typically, we talk about impact investing as the double bottom line, right? Because you're having that positive impact on society and the environment, but you're also getting a financial return. And historically, that's been mostly in the private markets, but there have been some public market opportunities more recently. And then there's thematic. So thematic would be selecting securities in a really granular ESG theme, whether it's green energy, health innovation, diversity, and leadership. So when we think about those 5 options, or 4, if you count screening all as one, and you have them on a continuum. So on the continuum of ESG product, if you have screening on one side and you have thematic on the other, and you think of cost, you think of diversification, you think of tracking error, where you're going from the lowest cost, the lowest tracking error, and the most diversified with negative screening, all the way to the most expensive, highest tracking error, less diversified with thematic. So just quickly going through them upside downside for these: negative screening, transparent, really easy for your clients to understand what they don't own. I don't want to own that company, and so you don't. But if you think about that on the downside, then you have a lack of exposure to whole industries and sectors, perhaps, that can drive short-term performance differences to the broad market. And also, you're not tapping into those companies that perhaps are managing their ESG risk better and transitioning to better operating environments. So then that takes you to the positive screening, right? So you're like, I'm going to go for the companies with the high ESG ratings. Maybe I'm going to capture some of those companies that are managing their risk better. That's true. And it is probably still on the transparent side. But the issue with the ratings, the standardization of ratings or lack thereof is real. Unlike, credit ratings where S&P, Moody's, and Fitch, kind of walk in lockstep, that's not the case for ESG ratings. You can have an electrical vehicle manufacturer has a very high rating from one agency and a very low rating from another. And the other point is that they're backward looking, right? It's from company disclosures that are done on a quarterly basis. So you don't have that kind of forward looking, where's the company headed, that you might get if you invest in active ESG, where you have a fundamental manager who's evaluating the ESG risks, they're engaging with management, engaging with the board. Of course, in this one, it might be a little bit harder to align your values, because they may say, we're actually going to invest in an alcohol producer. Why? Because it's a financially strong company. People aren't going to stop drinking necessarily. And this particular company really invests in responsible drinking campaigns. So they're having a positive impact on society. And from an environmental perspective, they're managing their water usage, not only at the company, but they're reducing it in their supply chain as well. And then moving on to impact investing, again, both impact investing and thematic, you can really target your investments to match your values. But with impact investing, typically, as I said, it's been private equity. So you could have a long lockup, and you need to be cognizant of that, for the liquidity of your portfolio. And then for both of them, less diversified, higher tracking error, typically a higher cost. So again, if you look at that continuum from screening to thematic, as you're going along, it's really important to have conviction in the approach, because the complexity and the cost goes up. So sorry about a little long-winded.
No, that's wonderful. I think that you've really, in a very understandable way, hit the primary ways that people are ESG investors. And when someone's trying to choose the right strategy for them, and we've talked about factor, we're talking about ESG, we will talk about indexing in a moment. Even when you get to the ESG, I think that's where things get complicated, because you really need to understand the why, and you need to understand, is meeting that why or not meeting that why. With all that in mind, Natalie, who do you feel like at a high level, regardless of the approach they're taking, is a good fit for ESG investing?
I think that the simple answer, Peter, is anybody who wants to align their investments with their personal values. But, it's then the fun begins once you decide you want to be an ESG investor. But it's interesting. The fun is the same as if you weren't, right? What are your goals? What are your options to achieve those goals? What do you decide as your approach? How do you document it? And then how do you assess it? Right. So that's what you do with your clients today, whether they're ESG or not. But the next part is the interesting part, the balance, right? The balance between satisfying your values preference, generating a financial return, and hopefully affecting a meaningful change.
Well, that balance is actually a nice transition into something I want to talk about that I think Natalie and Liz, you both might have some input for, is stewardship and the impact of proxy voting. Because in my mind, Vanguard was really one of the first people to be first fund providers to be very vocal about their role in stewardship. And for the ESG funds, when you vote proxies, you have to vote according to what your ESG goals are, but you also have a fiduciary duty to the shareholders to earn a return. So I would love how maybe Natalie, you can start us by explaining how maybe a fund manager balances the ESG objectives with that fiduciary duty to the shareholders. And Liz, any color you can add across all of the Vanguard funds would be wonderful.
Yeah, so really a very important question, right, that you should ask any of your ESG fund managers and understand if those votes are being made at the fund level or the firm level. And as I think about our sub-advisors and our active equity group, it's very definitely being made at the fund level. As I said before, when I was talking about active ESG, these are critical tools for them to not only find the best companies, but also to influence them to be better, basically, because really there's no one perfect company from an ESG perspective. Nobody's hit that mark. It's really more about improvement. So these fund managers are trying to find the leaders in a particular industry, and also those that are making a commitment to ongoing improvement. And then they have the dialogue ongoing, whether it's through engagement with the board or voting and proxy voting. And in terms of balancing the two, I guess the way I look at it, Peter, is that really the two objectives are really intertwined. If you start with a belief that unchecked material ESG risks can potentially negatively impact long-term returns, you really have to balance both as you go in. But and I know that these issues are very complex. They're very nuanced when you get to a company by company level. And definitely what we've seen as that complexity has gone up and there's just been more and more focus on ESG, we've seen companies put a lot more resources towards their stewardship function, their proxy voting function. And importantly, you can go out on people's websites, the fund managers' websites, and you can read their proxy voting guidelines. And sometimes you can even read how they voted on specific issues.
And Liz, I think you had mentioned you've really touched a lot of Vanguard over your career, and the active funds naturally are going to take advantage of their ability to vote shares. But even index investing, which is, quote, passive, has this really active side in it when you think about the stewardship. And Vanguard, again, being one of the first fund managers, one of the largest fund managers to say, hey, this is what we're doing. Can you talk a little bit about how that that manager stewardship plays a role in index portfolios and even the factor strategies that we were talking about earlier?
Absolutely. So, I think it's important to just contextualize that an index fund is likely to be both a large holder of a stock as well as an extremely long-term one. In many cases, they're holding some of these stocks almost in perpetuity. Now, some critics, as you said, will view those investments as passive when it comes to proxy voting, but it doesn't have to be. Our engagement with boards over Vanguard's history has been anything but passive, and our goal has always been to focus on driving long-term value for investors over the holding period of that company. So our stewardship team, which is actually quite large now, is focused on a few key principles that are aligned with long-term investment value. Number one is board composition and effectiveness. So they're looking for a board for each company that is diverse, experienced, independent, and committed. And so nominees for the board will be evaluated against that criteria. And if they don't meet all four of those benchmarks, being diverse, creating a diverse board of experienced people who are independent and committed, that will lead to Vanguard sometimes voting against the recommendations. Second is the board's oversight of strategy and risks. needs to have both appropriate disclosure to shareholders as well as evidence that that oversight has alignment with shareholders in decision making. So we're really looking for the board to evidence that it is thinking about long-term investment value when both making decisions about strategy and the direction the company is going and the way that it's getting its funding, as well as how it's managing risk. And that can even include ESG-related risks. The final thing is executive compensation. Executive compensation should be, in Vanguard's view, structured in a way that incents long-term outperformance of that company's peers. So not short-term outperformance, not goals that are disconnected from the success of investors in the company, but something that really, again, it's about alignment. It's almost going back to what Vanguard believes in. We believe in alignment with shareholders, and we're holding company boards accountable to ensuring that they manage the company in a way that is aligned with investors, so that the passive investors in index funds are actually getting the most out of their long-term investment in those companies.
I love how you both really outlined that stewardship piece is so important. And pivoting back, kind of a hard pivot back into these case for these different strategies, we're talking a little bit about indexing. And I've always felt like there are a few reasons someone might index. So let's start there, Liz. What do you feel like is the case for indexing?
Well, I think it's always come down to, I think, four main things. So one is the concept that investing is a zero-sum game. For every stock that outperforms, there is a stock that underperforms. For every manager who is outperforming, there's one taking the other side of every single one of those trades, hopefully not all of them at once. And so the market average is actually derived from that. And the concept is that, it's really hard to make sure that you're always on, the positive side of that distribution chart. The second thing is cost. Every piece of research shows that costs are a significant influencer of long-term returns, and the lower the cost, generally the better the long-term investment results. So the fact that indexing can be done at low cost is a real tailwind for investors in that strategy. Continuing on the concept of cost, tax costs matter. So taxes can also really eat away at investor returns. Most traditional index funds, especially market-weighted index funds, are managed in a way that is fairly tax efficient and reduces the bite that taxes take out of investor returns, allowing after-tax returns to look much closer to pre-tax returns. And then, maybe the final point is, even if you believe that, there is an opportunity to outperform, that you can, if you're investing in an outperforming manager that is also low cost and is also long-term, and so they're tax efficient and, and all of that, it's very difficult to actually choose that manager in advance. And there are a lot of people who will look at things like 3 and 5 year past returns. And there's been research that shows that looking at historical performance actually is not a great way to choose the outperforming manager for the next 5 years. So understanding that difficulty, I think really creates an opportunity for indexing. We know that the average active investor underperforms long-term after taxes and fees. So why not index?
Well, and do you see any potential downsides to someone who's indexing, or maybe also any ways that people are indexing incorrectly that's harmful?
Yeah, so I think there are definitely things positioned as indexing that aren't. So it's important to know your investment. If it's an alternatively weighted product, there are elements of active management there. Some firms, I don't understand how, but some firms still offer high cost index products. So you really need to understand what it is that you're invested in. And I'm not saying that those are bad things. Some advisors actually build, customized exposures to client objectives using index products. And so they get a little bit of both, but you really need to know what it is that you're trying to achieve. Another piece that's maybe a potential downside is going back to the two topics we talked about earlier. So factor investing and ESG investing. In a traditional index approach, you are exposed to the largest stocks in the market, the largest issuers in the bond market. And so, if you wanted to underweight or not hold a company you're concerned about from an ESG perspective, from a debt load perspective, or if you wanted to benefit from a small cap or value premium, an index approach in its purest sense doesn't really allow for this.
And do you feel like, Liz, there is anybody who is a particularly good fit for index investing?
I think that anyone can be a good fit for index investing. It's almost like the default approach, and there are reasons to move off of it into ESG or into factors. But there's just a lot of positives about getting the market return from both a fiduciary and an investment perspective. Set it and forget it. Every time you compare your fund's performance to the market, there it is. So somebody who's seeking consistent and transparent exposure to an asset class, who would benefit from reduced transaction costs, management fees, and tax costs. If somebody doesn't have the stomach for an active manager or a factor strategy, indexing is a good idea for them. We know that behavioral dynamics show us that most investors don't stay with an active manager long term. So even if it's the best manager, they tend to buy high and sell low. And so what we describe as the time-weighted returns, the returns that you actually see in the annual report, end up being better than the asset-weighted returns, the returns that investors actually get from kind of buying into the fund based on past performance and then being disappointed and leaving the fund before there's value recovery.
That's such an important part of the equation here. And all three of these strategies, index, factor, ESG, in the way that, at least that we're implementing them, are very rules-based. And so the second that you are not in an index fund, your return is going to vary from an index fund. And you heard, can't remember one of you using the word, or maybe both, but tracking error. So for those listening and don't understand the word tracking error, it just means how different you are from the benchmark or the index return. And we know that it's really important with factor portfolios to live through periods of underperformance. They are to be expected. And ESG can also underperform. Recently, it's done very well. But I think that when you're in an ESG portfolio, perhaps the assumption is that you have made that choice for more of an emotional reason and you're willing to underperform a little. But I do think that if you don't want to underperform ever, an index portfolio will never underperform. It'll never outperform either. You just get the index return minus the cost of the funds. And that's really where those costs are so important. Both of you have really helped, I think, make this very clear. I just have a couple other questions to close out that I ask all my guests. The first one is a little open-ended in the sense that I would love to hear if you have any book recommendations, either that influenced the way that you view the world from an investment perspective or on the topics that we discussed today. Natalie, why don't you start?
Sure, I would love to. Now, I'm going to pick a Vanguard book, but it's not a given because I've only been at Vanguard for a year. And I think Liz used the phrase before, and it's both from the content of the book, but also the title of the book, and it's Stay the Course. And it talks about the history of Vanguard and indexing, but it also talks about our active management as well. So I think it gives a great encapsulation of ways to approach the market. But I think the title is so important because of people's behavioral biases. It's so hard. I remember being on an international growth team, in 2012, 2013, and underperforming, and, people are getting nervous, clients, and these are institutional clients too, which typically have a little bit longer time horizon. And so important to stay the course, stick to your knitting, because you have to realize that that's why people purchased your product, right? And if you start to vary, it's going to have an impact on their portfolio. I think it's also important for individual investors, myself included, for right now, right? We're in a particularly volatile time in the market. So very important to go back to, what was my plan? How was I going to execute it? Has anything changed in the things that I can control? Not the market, because you can't control that, and if it hasn't, then, stop watching the news and stay the course.
That's great. Liz, what about you?
So I actually brought a visual, but mine is an investment classic, Winning the Loser's Game by Charlie Ellis. I didn't want to pick a book that was so clearly identifiably a Vanguard book, But, little secret, Charlie actually was on the Vanguard board from 2001 to 2009. So there's still a Vanguard connection there. But anybody who hasn't read this, I just think there's such wonderful, timeless investment advice and understanding that, things like being long-term and setting strategic goals really can help you achieve your investment objectives of sending your kids to college and retiring and being able to take trips and, be financially stable. And I think Charlie Ellis's way of putting those concepts together is anything but dry. So for any of your, listeners who have not read this book, it's not, overwhelming in terms of size. It's got some moments of irreverence, and it is, pure investment classic in terms of material.
I'm a big fan of both books that you guys recommend there. One final question, and Liz, I'll let you start. What does it mean to you to be a long-term investor?
Well, I think it's an interesting question. For me, I think it's really about mindset. There's so much that we do as humans by reacting emotionally to what's happening in the world and what's happening with our investments. And, I think right now is a perfect time to point that out. There's so much news going on right now that if you're focused on it, you could actually be, worried and stressed every single day about what's going to happen to my investments. And, what about Eastern Europe might affect me? And what about what the Fed is doing might affect me? And, the level of information can actually lead to being in a constant frenetic emotional state about your investments. I think as a long-term investor, I have to know what's going on because I talk to people, but I separate that from my personal investment portfolios. I almost never touch them. I look at them once a year, I rebalance, and make sure that everything is aligned with my objectives. And yet I'm talking to advisors every single day about the markets. So I think it's about making sure that behavioral bias doesn't undermine your ability to stick with your plan and your long-term goals. And sometimes tuning out the noise is the best thing that you can do for a long-term investment horizon. I'm still fairly young, I think. So I look forward and think I have, 10, 15, 20 years for my investments to continue to grow, continue to add value. And so I don't need to stress about what's happening this week or this month or this quarter in terms of the world and how it's affecting my investment portfolios. And so that's how I keep that long-term focus.
Well, and I'm assuming that 10, 15, 20 years you're mentioning is to retirement. Then you get another 10, 15, 20, 30 years. So the time horizon's almost double. That's a wonderful answer, Liz. I really appreciate that. Natalie, how about you?
It's as Liz was talking, it just so resonated with me because what? It's funny. If you just pick the last 20, 30, 40 years, the uncertainty has not changed in the market, right? The difference is the level of noise has gotten so loud. I think we need to all walk around with noise canceling earphones on if there was such a thing, really, to try to block it out, because time and time again, it's proven, right? We can just look back to 2020, right? It looked like the markets were falling off the end of the earth, and they did for a very short period of time. But if you chose to get out at that point in time, oh my gosh, right? Straight up right afterwards. And, there's no doubt in my mind that we are in the same situation. And if you're a long-term investor, you have to stick to your goals. It doesn't mean that something can't change in your own situation, right? But being able to, guard against those behavioral biases and not give in to them, I think is important. And I think what Liz says is true. Look at your portfolio once a year, unless something changes in how you documented what you wanted to do, your goals. You won the lottery. Okay, maybe you want to change your allocation, rather go with something positive, right? But otherwise, long-term still means the same thing it did 20, 30, 40 years ago. The difference is the amount of so-called information that's being pushed at us.
Great answer, Natalie. Liz, Natalie, thank you both so much for joining me today. And for those of you listening via podcast, go ahead and leave us a review and comment which of these three portfolio strategies resonate with you. Or if you're watching on YouTube, you can like and subscribe, comment there. Those sort of things help other people find the show, as well as influence what we talk about next. Until next time, to long-term investing.